Neelkanth Mishra, Managing Director and India Equity Strategist at Credit Suisse, is joining us on the show right now. Neelkanth, thanks very much for taking out the time, and it's important to get your opinion on a day like this. You did have the Fed coming out with its 25 basis point hike, though the outlook has been trimmed to just 2 hikes in next year versus 3. Global setup now gaining more prominence than what's been happening in terms of domestic indicators for our equity markets. How would you place us right now in the run-up to more volatile times ahead of the election as well?
Right. So, see, globally, we are in a situation which we haven't been in for the last 2 years. In the last 2 years, global growth estimates were being continuously revised up, even though marginally. The period before that was where global growth was persistently being revised down. And I think we have now, in the last 6-8 months, reached that point where, again, global growth estimates are being questioned. I think we are seeing, we should see more downgrades in the coming quarters. Some of the signals coming from commodities are not very encouraging. So the first leg down of oil was mostly supply driven. I think the supply constraints that were feared didn't really come around. Then there was a technical correction where long positions were inbound, but the last leg down is actually very worrying. It suggests that demand is coming off very sharply. Now, the central banks have been on a tightening, have had a tightening trajectory. The global central bank balance sheets are expected to shrink by $430 billion in the next 12 months and about $900 billion in the next 24 months. Interest rates were to be hiked, as you just said. The Fed was expected to hike by 3, now they're saying 2. Some people were at 4. I think they'll have to all cut their estimates. Now, for the central banks whose primary mandate is the economy to actually transition or change their rate guidance or rate hike expectations, you need to have significant market volatility. And I think that's what we are seeing right now. So for those changes to happen, I think the global markets in most of the foreseeable future, I think, will be quite volatile. Coming to India and the implications, see, net FII buying in the last 3 years has been close to zero, as almost insignificant as a percentage of market cap. On the other hand, domestic flows are at $15-20 billion a year. That, I think, provides a lot of stability. But we have to be very cautious in the sense that India's price to earnings premium to that of the world is now already nearing its last 7-8 year highs, and that's something that can act as a cap on price to earnings. So as the domestic economy slows, I'm actually less worried. If you're taking a 12-month view, I think the election should be not that important, in the sense that they cause a lot of news flow, they cause a lot of volatility, there's a lot of noise. But if you look back the last 20 years and looked at market performance 180 days before and 180 days after election results, there is no visible change in direction. So it's actually the economic momentum that and perhaps flows, domestic flows, that will decide the prospects. And on the economy itself, I think the signs are not that good. There are the economy started weakening much before people had expected. There was a statistical weakening. What I call that is, the second half last year had higher growth and therefore had a higher base, and therefore visibly or statistically the economy growth rate was supposed to correct in the second half. But it started weakening even in the second quarter, and I think the 7.5% kind of growth rate for FY20 now looks very difficult. So those are things that I would worry about. I think the global markets, I don't think, have been stable for a while, so I think that will just continue.
Neelkanth, is there a shift in the theme that investors are keeping in mind while investing in the Indian equity markets? So up until now, where consumption-driven names were key in focus, and consumption as a theme held the spotlight. Is that transitioning towards something else, like probably more capital-intensive spaces, more investment-driven spaces, and that could be the next driver?
All right, excellent question. So I see the consumption as a theme, I think, has worked for the last 8 years. In fact, some would say that, and in absolute terms, it's actually never really corrected meaningfully. It's just that it is outperformed meaningfully in the last 4 or 5 years, and investments and industrials have actually not done so. See, there are a couple of things that are changing. The first is that there is the pay commission. I think the pay commission is a very, very large consumption stimulus, and a very potent one, in the sense that if in the private sector, I mean, most people are not really clear till the day they get their bonus as to what the bonus is going to be. And secondly, the pay hikes, you can never assume that they will be there forever. In governments, for public sector employees, the hikes happen once a decade. They're very well flagged. You know that within the first 1 or 2 years of 2006, 2016, in the case of seventh pay commission, that the hikes are coming. More importantly, that it's a step jump. So it's once you are at that level, it's very unlikely it's ever going to come down. So the impact on consumption of something like that is actually very, very significant. And so we've gone through, so that the sixth pay commission was a bit delayed. It was supposed to start in 2006. It was announced in the middle of 2008. It really started happening in 2009. And then the state governments kept doing it in 2010-11. We saw 2-3, and then it happened that 2014-15, I think, was a lull. But 2016 onwards, again, the implementation started. So we've seen a period where very large increases have happened to government salaries. In terms of quantum, the seventh pay commission, we estimate, added about 4.5 trillion rupees, 4,50,000 crores per year to the salary and pension bills of state and central governments. This is a huge stimulus, and the impact of this was, I think, felt very much on the discretionary space, and I think second order effects also to some extent in the staple space. And as we proceed forward, I think there will be a lull as the non-government incomes now need to catch up to support the car sales and the two-wheeler sales and all that. The problem is that income generation depends on GDP. So if GDP growth is not really accelerating, then it may take longer for that base to catch up. And I think we are due for some disappointments. I mean, we'll discuss the loan waiver issues perhaps if you want to, but the point is that I think consumption growth has been slowing, and I think it will continue to slow in the foreseeable future. And that's not something the market's really geared up to. Investments, on the other hand, it's a part of the business cycle. I mean, if you set up 40 million tons of steel capacity in one go, and your base is 60 million tons, it takes 5-6 years to fill that up. But once that is filled up, you don't really have an option. You need to set up the steel capacities. There is also serious supply constrained sectors where we have, because of political will, because of just the fact that we didn't know how to do it, I think those issues have constrained supply addition in sectors like water management, sewage management, and urban infrastructure, metro rails, say railway infrastructure. And some of those investments are now starting to happen, and they are supply constraints. So there's no reason why these need to stop fundamentally. And therefore, our view is that given that the market absolutely doesn't price in any improvement here, that partly because the capacity in the economy is now filling up, and partly because the governments at the pace of GDP growth will keep doing some capex, we think that the sustainability of this GFCF recovery, the gross fixed capital formation recovery that we've seen in the last 6 quarters, is for much longer than what the market pricing in. And that's where the investment opportunities lie.
Interesting. Neelkanth, Neeraj here, and well, always good having you. twice in 10 days. It's a pleasure. Let's just talk about the point that you mentioned, the farm loan waivers. And it's from a market perspective, how big a worry could it be? One, I think you made a reference, passing reference, if I'm not wrong, to maybe GDP slowdown that could happen as well. Are you also worried about the fact that if 2 states or 3 states have done it, over the course on the build up to the general elections, more states may do it, and that is the pressing worry?
Yeah, the pressing worry in my view is the announcements, not as much as the fiscal side. So let's look at it a bit more holistically. The first is that many big states have already done it, right? So Andhra Pradesh, Telangana started it off 2015. Then we saw UP and Maharashtra. Then we saw Karnataka, Punjab, Rajasthan. Tamil Nadu did it for the cooperative banks 2-3 years back. So it has been, and it's not that big a political issue yet in Bihar, Bengal and Odisha, partly because there's not that much of institutional credit that has actually been issued there. So there's not too much more to happen, if you ask me honestly. The second is that fiscally, we have to keep in mind that, and I think the state governments have to keep in mind that their fiscal deficit ratio is actually capped. So under the Constitution, Article 293, every single rupee that they borrow has to be with the permission of the central government, and the central government does not allow does not allow states to breach that 3% level. So the year in which UP did the loan waivers and it also had to implement the pay commission, it did nothing else. So there was no other expenditure increase that happened. So in terms of aggregate handout, so if you spend so much on farm loan waivers, someone has to pay for it, and that payout could happen because there is no additional spending on agriculture or on education, on healthcare. And therefore, the net economic impact of that is more redistributive than just really the fiscal stress. The bigger issue is that this is the least potent of a government spending in terms of a fiscal multiplier. See, as the government spends, if you build a road out of it, the multiplier in the first year and 3-5 years out is actually very high. If you even hand it out to people, there is a meaningful number. If you do a loan waiver, actually there is very, very little impact on consumption because there is no fresh cash going to the farmer or to the individual. And what happens instead is that in a hurry, you announce a farm loan waiver, and of course it's a political statement, that's the reason why it's done.
Right.
But the implementation of this could take 6 to 12 months at least, and there are states which have been struggling with 24 months. In the interim, the banks, because the farmer just says, okay, the farm loan has been waived, so I'm not going to service my loan, the banks just stop issuing fresh loans into those geographies. And so the inflow of fresh cash into the economy actually slows down. So it actually has a very, very bad effect on economic momentum.
Yeah, maybe that's something that is that's something that you are baking in. Please make a point. Please make a point.
No, it's okay. It's okay. So I think so there are multiple issues here. The first is, of course, I think the market just takes there is a farm loan waiver, so there is like a dole, but that dole does not drive higher consumption. So I think some of the market reaction on that front is I think a bit premature. If the read-through is that this means we will see more and more such policies because this is turning out to be a big political issue, and that's actually, if that is the view, then well, there is some rationale to it, but I suspect that is not what people who are buying these stocks are thinking. What I mean to say is farm stress or agricultural stress, I think, has been there. We've been flagging it for 2.5 years that it's a problem of surplus. We don't know how to handle it. And I think policies are only now starting to change towards that. But it's not going to get resolved in the next 5 years. So I think this is going to be a persistent point. I think the governments need to figure out ways of handling this. The expectation that a scheme like Raitu Bandhu from Telangana, where 4,000 rupees an acre were handed out in checks twice a year for every season, it is not possible for other states to do it. I mean, first thing, you don't have clean land records against which you can do it.
Right.
Secondly, Telangana, even in the first year, was spending 12,000 crores, 1.5% of GDP. That's not something that any state can afford. So, so this is as a change, as a policy priority is there, but I don't think the spending will really happen.
Another market dynamic now is going to be the coming of the new RBI governor and the stance that he takes within the given framework and what it does for the financial industry and how that changes things around. I mean, he's worked on both counts. He's worked with the government as well. He's worked in close quarters on the finance ministry, and he's open to dialogue with various stakeholders here. So do you feel that this could be, you know, a silver lining now, and a little bit of relaxation could be seen for the financial space as a whole, and particularly for banks now, and the turn in the investment rationale?
So, so that's I think we've discussed this before in Neeraj's show. The point is that, you know, most governors before the last two used to come from the finance ministry. So I don't necessarily fear for the worst when it comes to RBI independence, etc. Just because the new governor has worked in the government, because it is about the institution they're working for, etc. So I don't think it will just that the views will be colored by the fact that they've worked in the government. But coming to the policy action itself, see, I think the Monetary Policy Committee has made it very clear that they're only focused on inflation. They have come in for some criticism. They were when the rupee was falling and people thought that they should slow down the economy even more, but they said no, we are only worried about inflation. And well, inflation is now down, and they have cut down their forecast. They did not change their stance in the last meeting, but maybe now they change their stance and the rate cuts happen. So independent of what, so this is the point of having a monetary policy committee, right? That you have some institutional continuity, that there are 5 people who are going to be the same out of 6, and the fact that it's a formula-driven process, more or less. At least from what they've guided to. And if inflation follows the trajectory it is following, then rate cuts are obvious, right? It's not rocket science. The bigger issue is the financial system's ability to lend. See, there is a shortage of capital. You know, if non-banking finance companies, of course, I don't think, I mean, with this kind of liquidity injection, I suppose failures are very unlikely. But where is the capital to grow? If NBFCs, the non-banking finance companies, are not willing to grow, or are at least till March, April, are going to constrain themselves from growth, where will credit growth come from? So all of these open market operations, the incredibly high amount of liquidity that is being injected by the RBI, will it really result in higher credit? And that's the big question mark, because based on the availability of capital, based on the growth in equity values of financial firms, it doesn't look like there will be space to grow aggregate credit by more than 10 trillion rupees, which in the financial system, overall financial credit means only about 8-9% growth. How will the economy grow with that? And the bigger issue is that despite the fact that so much of currency has been printed, is the currency really moving into the right hands, in the sense that the repeated feedback that we get from our channel checks, our field trips, and other people doing the same field trips, and companies now increasingly, is that they feel that there is not enough money in the market. Right. Now, this is all anecdotal and of course not very scientific, but is the cash really going where it is needed? So it is a very deep monetary problem, and I think those are the solutions that we should look forward to. I think the issues about, like OMOs themselves, I think are a sign that the RBI does want to provide liquidity. I think the next question will be, how do you make it available to the borrowers?
Yeah, and I think time will tell and give those answers to those questions as well. We could go on and on, but out of time completely. Neelkanth Mishra, so good having you. Thanks so much for joining in.